Howdy, everybody. Welcome to Liberty Call. Today is Friday, April 11th, 2025. Hope you're having a fantastical day out there in the interwebs. Gorgeous here in Colorado. I mean, just amazing. Again, I got shorts, t-shirt. It is so nice outside. Soaking up some sun, some vitamin D. Try not to get a burn on my head. So, anyways, got to report some sad news today. My old man, Ray Jr., passed away last night around 9:10 Central Time at the hospital in Nassau Bay. So that problem has come to a close. So we didn't think he was going to survive. He had sepsis, heart failure, and he just didn't take care of his health. So that is a warning to everyone out there. Just 75, probably could have lived another 15, 20 years if he'd actually taken care of himself. But diabetes and all those sort of things kind of wear on your body over a course of a few decades. So anyways, all right, well, let's get back into the real important stuff. Markets are bouncing back today, but do not let the green fool you. The U.S. Cranked tariffs on China up to 145%. China fired back with 125% tariffs of their own, and bond yields are screaming higher. JP Morgan crushed earnings, but warned of rough seas ahead. Yeah, that makes sense. Inflation may have cooled in March, but with this trade war heating up, that won't last long. So before we break all the news down, if you could do me a favor, give me some thumbs up, a like, share, subscribe, or follow, and press that notification bell. All right, well, let's jump into the markets for today. Dow Jones was up 1.56%, 619 points, closed at 4212. S&P 500 up 1.81%, 95 points, closed at 5363. NASDAQ up 2.06%, 337 points, closed at 16724. The VIX was down 8.1% today. It's at 37.55. Canada up 2.49, Brazil up 1.05, and Mexico flat down 0.03. Headed to Europe, Germany down 0.94, the UK up 0.64, France down 0.3, Netherlands up 0.04. Excuse me. Spain down 0.18, Italy down 0.73, Switzerland down 0.11, and Portugal up 1.81. Let's see here. Russian exchanges both green. MOEX up 2.43, RTSI up 3.66, and the overnights, the Nikkei in Japan was down 2.96, Australia down 0.82, New Zealand down 1.6. In China, the Shanghai up 0.45, Shenzhen Component up 0.82, China A50 up 0.68, DJ Shanghai up 0.54, Hang Seng up 1.13, and the Taiwan weighted when closed on the 10th was up 9 1/4. That's a lot. All righty. Let's jump into our charts. And let's see. Let's go to the 1 week. Take off my trend lines. And let's get started. All right. So starting out with the Dow Jones. It's going to finish the week barely green. Well, I guess it doesn't look like it's going up very much, but it's actually quite a bit with all the jumping around. 4.92% for the week. So all in all, not too bad. It doesn't look that extreme, but we had a pretty wild week. S&P 500, let's see, it's going to be green by 5.63%. NASDAQ, let's pick up that last candlestick right there. Looks like it's going to be up about 7.24%. The Dow Transports, up about 2.19, and the Dow Utilities up about 2.16. So let's zoom out and go to the daily, and we can zoom in on the daily, and we can see here just in the last week. I mean, we went from here on Wednesday the 2nd we were down about 10% within 3-4 days. Back up another 6.5. And so, the volatility is quite large right now. So zoom out and let's go over to the S&P. Looks the same. NASDAQ looks exactly the same here in the short term. So anyways, all right, let's get that off the screen. Put my trend lines back on so I know what I'm looking at on Monday when I get to work. All righty. Well, let's hop into the economic data for the week. Starting out with jobless claims. Initial claims came in at 223, right on forecast. Previous number was 219. Continuing claims came in at 1.85 million, forecast 1.88, previous number 1.893. Consumer credit came in at a contraction of 0.81 billion. Forecast was 15.2 billion. So there's a bit of a discrepancy there. Previous number was 8.9 billion. The NFIB Small Business Optimism Index came in at 97.4. Forecast was 98.9. Previous number was 100.7. So bit of a dip. It's been going down here the last few months. Wholesale inventories month over month grew at 0.3%, right on forecast. Previous number was a 0.8. And the consumer price index year over year grew at 2.4% under the 2.5% forecast. Previous number was 2.8. Month over month, it actually contracted by 0.1%. Forecast was a 0.1% growth. U.S. federal budget balance came in at negative 161 billion. The forecast was negative 115.9 billion. Previous number was negative 307 billion. So depending upon how you look at this, it's improvement from last month, but about 50% more than the forecast for this month. So again, producer prices index. This is kind of like your consumer price, kind of like your inflation gauge. But for prices that producers are paying, came in at 2.7%, forecast 3.3, previous number 3.2. So cooling off a little bit there. And it contracted on a month-on-month by 0.4%. The forecast was 2.2 growth. And the last bit of data for this week, the Michigan Consumer Sentiment came in at 50.8. Forecast was 54. Previous number was a 57. And I mean, you can see here. Why is it not scrolling? It's stuck. All right, there we go. There we go. All right, so you can see going back to, when was this? January 10th, December 20th, it was up around 74, and now we're down in the low 50s. So it's been going down quite a bit here, the sentiments here domestically. So, all right, get that off the screen. Let's go to the market recap and jam through our articles before we head off to the weekend. Wrong button. There we are. SP 500 eyes positive into the wild week in green as tech continues to shine. All right, SP 500 finished higher on Friday, rebounding from earlier losses despite escalating U.S.-China trade tensions and troubling signs for the U.S. consumer and inflation outlook. The April University of Michigan Consumer Sentiment Survey showed household confidence plunged 11% in March to 50.8, the second lowest reading ever recorded. The decline reflects growing consumer concern over rising prices, personal finances, and fears of unemployment amid Trump's aggressive tariff policies. No one seemed to have a problem 4 years ago, 5 years ago, when they were printing money like it was going out of style and created all this inflation, and then just stands there with their hands in their pockets and goes, this is weird. I mean, again, the 400 economists that work at the Federal Reserve, I imagine they're commanding a pretty high salary, and they probably got a lot of fancy letters after their name. I mean, I've only got 4 CRPC, but these people have got MBA and all these fancy distinctions and designations, but they didn't know that printing $5 trillion and adding 40% to the money supply was going to create inflation. I mean, I did, and I've just read some economist books. I mean, I'm a student at this. I don't consider myself to be an expert. All right. Where were we? Inflation expectations also rose sharply, with long run projections climbing over 4% as economic policy uncertainty rattles households. Despite ongoing tariff worries, bond market stress eased somewhat. The yield on the 30-year Treasury bond fell to 4.836, alleviating fears that investors would dump U.S. debt in response to a potential trade war-induced economic slowdown. U.S.-China trade relations worsened further after Beijing retaliated against the latest U.S. tariffs by raising its duties on U.S. imports to 125%, up from 84% earlier in the week. China signaled it would not respond further to additional U.S. tariff hikes. Market volatility subsided by the end of the day, with the volatility index, the VIX, Wall Street's fear gauge, falling after spiking above 50 earlier in the week. Meanwhile, the first quarter earnings season of unofficially kicked off with solid results from major banks. JP Morgan Chase, Wells Fargo, and Morgan Stanley all beat expectations but expressed caution about the economy's trajectory. BlackRock's assets under management reached a record high, but its stock slipped slightly. Despite the troubling data and rising trade tensions, the stock market found footing as traders bought the dip. Whether or not that's a good idea will remain to be seen, particularly in sectors poised to weather the storm. Let's hope that that's what they did. The focus now turns to corporate earnings and how companies plan to navigate the volatile trade and inflation environment in the months ahead. Okay, say so. Next up, got some data here. The March PPI from First Trust. Mr. Andrew Opdyke did this report, so let's see what he had to say. Producer prices fell in March for the first time since October of 23, despite, offering a surprising counter to growing fears of rising inflation driven by tariffs. Despite widespread media attention on inflation threats, both consumer and producer prices moved lower last month. The key driver behind the decline was energy prices, with gasoline costs dropping a sharp 11.1%. Pulling overall energy prices down 4%. Food prices also contributed, falling 2.1% for the month. In total, goods prices fell 0.9% in March. However, excluding the volatile food and energy categories, core goods prices actually rose by 0.3%. Service prices slipped 0.2% in March, but are still up 3.6% over the past year. The decline was led by a 0.7% drop in final demand for trade services like wholesaler margins and a 0.6% fall in transportation and warehousing costs. Overall, the producer price index fell 0.4% in March, but remains up 2.7% year over year. Core producer prices, including food and energy, rose 3.3% year over year, a notable acceleration from the previous 2.3% annual reading. Looking ahead, volatility in markets and inflation data is expected to increase, especially as companies adjust purchasing plans to navigate uncertainty from tariffs. Importantly, the reciprocal tariffs announced by President Trump weren't implemented until April, meaning March's data reflects older tariffs on steel, aluminum, and some Chinese goods, rather than the broader tariff environment to come. This dynamic complicates the Federal Reserve's efforts to manage monetary policy, with rate cuts already implemented in late 2024. The Fed will be watching closely to determine how these adjustments ripple through the economy before deciding on its next move. Okay, good stuff. All right, one last article before I can let you guys go. From Zero Hedge, we are now in a global disaster, and that's in quotes. Larry Fink stunned by Trump tariffs. Larry Fink owns BlackRock, doesn't he? Or he's like the head of it. Why would you be surprised? I mean, it's not like it's a shock. You know, the Donald was talking about this last year, well before the election, what his plans were. Let's see here. BlackRock CEO Larry Fink voiced deep concerns this week over escalating U.S.-China trade war following President Trump's sweeping tariff actions. Speaking after BlackRock's Q1 earnings report, Fink told analysts he was shocked by the scale of tariffs, calling them unprecedented in his 49-year finance career. Man, he must be pretty old. Trump recently hit China with an effective 145% tariff rate, prompting Beijing to retaliate with its own hike of 125% on U.S. goods. Fink stressed that the market downturn from the tariff battle isn't just a Wall Street problem. It directly impacts millions of Americans' retirement savings. While Trump announced a 90-day pause on additional country-specific tariffs for non-retaliating nations, markets remain nervous. Fink acknowledged short-term economic risks, but pointed to long-term investment opportunities in AI and infrastructure as positives. However, signs of trade disruption are mounting. Amazon abruptly canceled orders from Chinese suppliers. Walmart pulled its Q1 forecast, and Tesla removed purchase options from its Chinese website. This reflects growing uncertainty across global supply chains. Goldman Sachs analysts warned that despite the temporary tariff pause, policy uncertainty remains extremely high. Businesses and consumers are hesitant to make long-term commitments, while global allocators are rethinking exposure to U.S. assets given the volatility. Goldman outlined 4 major downside risks for markets: persistent tariffs, unclear policy direction, potential simultaneous declines in U.S. equities and the dollar, and a fragile treasury market as a safe haven asset. Global trade is already being reshaped, but the market has yet to fully price in economic fallout, with growing risks of further dislocations, including a potential blow-up of highly leveraged basis trade in the treasury market. Well, maybe don't leverage your treasuries and you don't have these problems. Analysts caution that it's far too early to declare markets out of danger. The trade war may just be getting started. I agree. What was this? Yeah, worried about U.S. equities and the dollar having some collateral damage from this. Well, I would say maybe don't devalue the dollar 40% and you don't have these problems. Maybe don't monkey with the economy and hold interest rates at zero for a decade and dislocate the true valuation of equity markets to means of exchange. So I don't know. Again, these are very intelligent people. They seem to be more worried about how they're going to keep their pockets full. So all righty. Well, that's everything that I wanted to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'd be happy to help. All right. Well, hope everyone out there has a wonderful weekend. We got some Astros baseball. They didn't play last night, which made my evening quite boring. And they're back, I think, at home. They're playing the Angels, I think, tonight. So got baseball games this weekend. And then me and my family game planning how we're going to handle the estate issues for my departed father. So, all right. Well, hope everyone has a great evening, and I'll talk to everyone again next time. Adios.